When you sit down to value a company, your first instinct is going to ask, how risky is this company to me? But here's what I'd like you to do instead. Ask yourself, how risky is this company to the marginal investors in this company? You see, what are these marginal investors that I'm thinking about? They're the investors who are setting the prices for that stock. You and I, maybe I should just talk about me, don't have enough shares to affect the stock price. The marginal investors tend to have two characteristics. One is they own a lot of shares, millions of shares rather than thousands of shares, and they trade those shares. So when you look at the risk in a company, you're looking at how will those marginal investors perceive the risk in this company. We'll come back and see how that changes how we think about risk, but it does. Now, if you look at the different risk and return models in finance, they're all based on the premise, at least the traditional models in finance are based on the premise that that marginal investor is a diversified investor. Because that marginal investor is diversified, some kind of institutional investor owning tens of stocks, maybe hundreds of stocks, the risk they see in a company or an investment is the risk that it adds to a diversified portfolio.